talk a little bit about some of the recent price activity we've been seeing in the dollar, sticking with the trend that we've been seeing. It's recently into a new high, but pulling back as yesterday the PPI, and for the most part, inflationary concerns have been very muted. I guess this is about what you'd expect to see with expectations in terms of the Fed and expectations that they're going to be cutting soon.
Yeah, muted, I think, is an understatement, Ben. And I'm looking up here to see what CPI was. It looks like it was right in line just now. So really no surprise there. But that's really what's keeping check on the dollar here from breaking out to those highs above, that 98.5 area that we saw.
Yeah, Scott, I'm noticing the dollar selling off a bit. Again, about what you'd expect to see. We've got the numbers up so our viewers can see. On the month-to-month, CPI came in well below prior, which was 0.3. We had the actual come in line with estimates at 0.1 on the year-to-year, holding well below that 2% level that they're looking for. We're talking 1.8%. Core CPI, 0.1% increase on the month-to-month and at 2% on the year-to-year. We've got the dollar coming into new lows. Scott, talk to me because, again, with the dollar coming off a little bit, in theory, could be helping boost the indices. We've actually been watching the indices a little bit under pressure today, but I mean, we keep talking about how lower rates in theory are a bit of a tailwind for the indices, and it seems like the dollar is suggesting that we should continue to look for that to be the case.
Agreed with that, but I think there's still so many other risk headlines out there keeping the market in check. So again, in theory, the lower dollar here should be good for equities. I know equities are coming off of their lows, what they had just a hour and a half ago or so. But there's still so much more on the docket, so much more headline risk to the market, especially over the next week with the Fed next week.
Yeah, I've got a chart. Actually, we're pulled up the quad, but if we could pull up the chart that I have here, this is an interesting look. I've got candles for the dollar. We're watching the dollar has been on the decline. We've got the, for the most part, the ES in the purple line, which has been on the rise, although it has been consolidating a bit here. Talk to us a little bit about bonds and what you're seeing there in terms of reaction to the CPI. I would imagine, for the most part, with the dollar coming off, that we're seeing a bit of a bid.
We are, and after hitting that low last week, after the bad jobs number, which was around 205 on the 10-year, we've had a bit of a rally, and I think there are some tailwinds here. In fact, if it does continue here, we may see the 10-year back up around 220 or so. What's really interesting, though, is with the pullback that we saw last week, finally, we're starting to see mortgage applications and refis start to flock to the marketplace, which had lagged. You and I have talked about this. They have lagged for the longest time, and they finally flooded in over the last week or so. But I would not be surprised unless we get a cut next week from the Fed, which I don't think is going to happen. I would not be surprised, Ben, to see the 10-year trading back above 220.
All right, let's talk a little bit about this kind of number, the CPI, PPI, retail sales, for example, even later on this week. Are these the kind of numbers that can force the Fed's hand? I mean, there's a lot of talk about not so much if we'll get a rate cut, but more so when, and will that rate cut be a quarter or a half point? I mean, ultimately, the Fed's in a position right now, based on some of the data, where it seems like they've got to move.
Well, these reports that we get, CPI, retail sales, they're one-off reports. However, when you consolidate and bring them all together and the Fed digests all of them together, that's what they're going to be looking at, and that's what's going to be considered when they're talking about their next move. I can't see how they are going to cut 50 basis points. I don't see how that's even in the cards in one fell swoop. I'm not saying that they're not going to make multiple cuts this year of a quarter each. I can't see how they are going to cut 50 basis points. I also, based on the premise of their independence and the fact that Jerome Powell has really talked about how important that is, I personally don't see them cutting rates next week. However, they could set up the stage for a likely cut in July.
Yeah. Scott, are we at the point right now where a cut is necessary, or has the hint of one been enough? I mean, okay, so it hasn't. I'm wondering, but you said that you feel like there could be a possibility of not just one, potentially more.
Later in the year, if the economic data continues to be weak, I don't think we need one right now. I don't think that we've gotten to quote unquote, a dire situation. I mean, you've got, the market 2% off its all-time highs. Yes, inflationary data is weak. Jobs number last week was weak, but we've seen over the last few months, those could be one-offs where we've seen the next month have a big revision. But all points are really signaling right now some weakness in the economy. Obviously, with the G20 end of the month and all the build up to that and what's happening with China, that is really what I believe the Fed is waiting for. Not, that to me is the reason why they're not going to do anything next week. They want to see what comes out of the G20. Yeah. And if there is no resolution or no talks of a real resolution, and I'm not talking about, a headline Twitter tweet or anything like that, then for July, I would consider a rate cut. But I just can't see how that's happening right now, Ben.
Yeah, there certainly is a lot that's pending here now on these U.S.-China trade talks at the G20 or expectations associated with them. Scott, we recently saw, I want to talk currencies for a minute and then we'll let you get out of here, a nice lift in the peso. It came in reaction to news that the tariffs had been avoided, and while it posted a new June high, it's still below the May and the April levels. Significant levels up around 53. Should we expect to see anything initiative from the peso or the Canadian dollar for that matter while the USMCA waits to get passed by Congress? I'd imagine some of the chop is related to some of the unknowns until this thing gets approved.
You just used the word that I was going to use, the chop, and that's what we're going to continue to see, which, that's the volatility in the marketplace until we see some sort of resolution. But the peso did rebound real nicely here, but came into some resistance area here, and I wouldn't be surprised if it just kind of moves, a little bit back and forth here over the next couple weeks.
Scott, similarly in the UK, the British pound near the year low, but also in a bit of a holding pattern. The selection process for the new prime minister plays out. I'd imagine that we can expect to see more of the same.
No question. I mean, the market doesn't like uncertainty. The market typically doesn't trade well on uncertainty, and that's what you're seeing right now. So until there is some sort of resolution, good, bad, or indifferent, there is going to be continued pressure on the pound.